A company's standard accounting profit is rarely the actual number the government uses to calculate its final tax bill. While jurisdictions like the United States rely on an entirely separate set of tax accounting rules, the UAE Corporate Tax Law strictly applies what is known as the indirect method, established under Article 20. To enter this derivation process, a corporate entity must first prepare its baseline financial statements using either Standard International Financial Reporting Standards or IFRS for SMEs. Those financial statements must be prepared on an accrual basis. The law offers exactly one structural exception. Entities generating under 3 million dirhams in revenue may opt for cash basis accounting. The raw IFRS profit figure serves as the baseline for the entire calculation. To determine the actual legal tax liability, this number must pass through a statutory filter defined by the Ministry of Finance, a precise sequence of exemptions, disallowances, and limitations. This animated waterfall chart shows the exact mechanics of that derivation. We start with a large, solid blue bar representing standard accounting profit. Corporate controllers must master every step of this pipeline. Understanding the mechanics of these adjustments is the only way to accurately forecast and optimize the actual taxable base. Standard accounting naturally deducts regular day-to-day business expenses from revenue. The UAE tax code explicitly rejects some of those deductions to protect the tax base from artificial erosion. This waterfall diagram starts with accounting profit. We add red blocks representing absolutely disallowed expenses, like capital expenditures, bribes, regulatory fines, and dividends. Then comes the 50% rule for entertainment expenses. Half are allowed, but the other 50% is added back to the taxable base. The statutory logic here assumes an inherent private benefit exists within client entertainment. Because the expenditure is not strictly and exclusively for business purposes, the law restricts its use as a tax shield. This restriction does not apply to standard employment compensation. Costs like health insurance and routine travel remain fully deductible, provided they meet arm's-length market standards. These mandatory add-backs neutralize aggressive accounting practices, forcing corporations to maintain highly justified operational ledgers. Standard IFRS accrual accounting introduces a specific tension. It requires companies to recognize changes in asset values on paper, even when those assets haven't been sold. Taxing those unrealized paper gains generates a corporate liquidity crisis. It creates a legal tax liability without producing the actual cash on hand required to pay it. This flowchart forces a structural balance sheet divide into two statutory categories. The realization basis election ensures capital account assets, like heavy machinery, are recognized only upon final disposal. Meanwhile, revenue account items, like short-term inventory, are taxed on an unrealized year-end valuation. This realization election is irrevocable, except in exceptional circumstances. Making this choice permanently alters the company's long-term tax posture. Electing the realization basis gives capital-heavy businesses a critical structural tool to neutralize paper volatility and protect working capital from phantom tax liabilities. Corporations frequently manipulate their capital structures to lower their tax burdens, using heavy debt financing to generate massive deductible interest payments.
The UAE deploys a strict primary countermeasure against this strategy, the General Interest Deduction Limitation Rule. The limitation rule triggers if an entity's net interest expenditure crosses the 12 million dirham de minimis line. Above that, the allowable interest deduction is strictly capped at 30% of adjusted EBITDA. Any overflow interest can be carried forward for 10 subsequent tax periods. Furthermore, the specific interest deduction limitation rule explicitly disallows any interest deductions on loans obtained from related parties if the debt was acquired simply to pay dividends or return capital. These thin capitalization rules force corporations to align their debt structures with actual operational earnings, severely penalizing artificially over-leveraged entities. We return to the main waterfall model to map the final downward adjustments that shrink the taxable base. This updated chart shows the immediate subtraction of exempt income, specifically removing items like dividends from participating interests and income generated by a foreign permanent establishment. Next, carried forward tax losses allow companies to use previous severe operational losses to shield current profits. However, prior tax losses can only offset a maximum of 75% of the current period's taxable income. To utilize these losses, juridical persons must prove continuity.
at least 50% of the company's ownership must remain identical. After all adjustments, the main waterfall chart resolves down. This final glowing figure is the precise base multiplied by the 9% rate. Because of the 75% structural floor, even massive historical corporate losses cannot be used to entirely zero out a highly profitable current tax year. While the Article 20 derivation is mandatory for large entities, a complete statutory exemption exists to protect early-stage companies from this complexity. This visual diagram introduces the small business relief provision available for resident persons. Eligibility requires meeting a strict financial threshold. Total revenue must not exceed 3 million dirhams within the relevant tax period and all previous periods up to December 31, 2026. If an eligible entity makes this election, the mechanical benefit is total. The business is legally treated as having zero taxable income. This completely removes the administrative burden of calculating add-backs, interest caps, or loss offsets, and allows the business to simply prepare financial statements using the cash basis of accounting. By bypassing the entire derivation structure, the relief drastically reduces compliance costs. Early-stage capital remains highly efficient and strictly focused on operational growth. To protect the integrity of the 3 million dirham boundary, the Federal Tax Authority enforces a rigid anti-abuse clause. The clause targets artificial separation. This is the illegal practice of taking a single business and splitting it functionally, geographically, or temporally, solely to ensure each fragment stays under the relief threshold. If the FTA establishes that artificial separation has occurred, they will instantly revoke the relief. The business will be forced to calculate and repay unpaid corporate tax across the entities, alongside severe financial penalties. Standard IFRS accounting profit provides the data that Article 20 adjustments then refine into a final taxable figure. In the UAE, flawless financial accounting provides the mandatory, rigorous foundation required for any strategic tax optimization.